They never tell you these three ways of price action, and this makes all the difference from having losing setups like this into winning setups like this one. As the first step, we need to form a high time frame bias of the price action. This helps in knowing what the market has done recently and what is the trend of the high time frame. On this market, for example, which is on the S&P, on the daily time frame we had this price action that constantly created higher highs with higher lows until it found a local high, being the highest level we've had recently. And from this swing local high, we can see that the bearish candles are now more present than bullish candles, and also larger in size than the bullish candles, this eventually pushing the price down. However, the important part of this recent downside action is that the price breaks below the last swing higher low, this creating the first lower low we have seen on this entire price action. When we previously had higher lows, but then the market breaks the last low and it turns it into a lower low. This very first break is what you might have heard of as being a market structure shift, trend change, or change of character. They're all the same concept under different names. I tell you that because you might have heard of one specifically, but not the other. And what you need to know about this first break is that it's the biggest sign of a trend reversing from the previous trend, which was an uptrend, into a downtrend. Why a downtrend? Because we see a lower low swing point that just formed on the market, and a lower low is a swing point of a downtrend. On downtrends, the lower low is followed by a lower high. The lower high on a downtrend is an upside pullback that can't break above the last high. Now, of course, you can't know the exact level that lower high will end at, but that's where supply or resistance levels come in to help, because the lower high will oftentimes end on a supply taken from the previous high. So we look at the previous high, and the supply or resistance is the last upside candle before the market started the downside impulse. This would be the supply or resistance from the daily time frame, and it's around this level where we expect a potential upside pullback to end at, so it can then reject into downtrend continuation. But our key level of interest is right at this point, which is on the supply, and that should create a lower high that is then followed with a lower low. Basically the swing points that are met on downtrends. Price is pulling to the upside, and eventually it hits into the supply from the high time frame. Now after the price hits the high time frame supply, we want to switch into a lower time frame. It doesn't matter which one, it just needs to be lower than the initial one. For example, this is the same market, same price, same level, but seen on the 4-hour time frame. And here what we want to look at is a rejection from the supply. For example, we see that this candle was the first one that has hit the supply, and the next candle has closed bearish and is a reversal candle. When we see the early signs of rejection, we can open a sell setup from this supply, with the stop loss above the top of the supply, which is an easy stop loss placement to remember. On supply levels in almost all cases, we want the stop loss right above the supply. But the take profit is not that easy, because we need to analyze the price action. And what we care about the most are the swing points from this 4-hour time frame, and we see how we had a push to the upside, followed with a downside pullback, and another upside push which got into filling the supply. The supply is a rejection structure that pushes the price down into continuing a downtrend. A downtrend has formations of lower highs that are then followed with lower lows. So it makes sense to look at the break of the last low as a potential level for the take profit, since on a downtrend, past lows are expected to break down into a lower low, so the market can then continue the price action pattern that happens on downtrends, which they are repeated lower highs that are then followed with lower lows. So the take profit is being placed below the last low of this time frame. And always be careful of the risk-reward ratio. It must be at least 1 to 2. If it's less than 1 to 2, then the setup is not worth the risk. In this case, the ratio is almost 1 to 3, so it's all right, and the position is basically already opened. So we only need to have patience for the setup to close either way. And we can spot from how the price action is behaving the fact that it's probably going to end on a win, of course, as long as this downtrend pressure keeps holding. Now here it hits below the take profit with a wick. Let's see if it can get lower than that, preferably with a candle closing below it. Which eventually happens. We see it right here with multiple candles closing below the take profit, so of course ending as a winning setup. Now let's see another example. If we look on this price action, starting from this high time frame, being on the 4-hour time frame, the candles are sort of ugly, with many wicks. The trend is not that easy to notice. That's why it's super important to analyze the directional bias of the swing points, since we don't execute the setup from this time frame. We only care about knowing what is the overall trend, which we do see how initially we had a bigger push to the upside, followed with a quite small pullback before continuing the upside action. But after this upside action has set a high, After that high, the market started crashing down quite aggressively. So we want to look at the swing points. Since we started from an upside push, we have a swing low that is then followed with a swing high. From this high, as I said, the price pulled back down and ended on a low which was higher than the previous one. So this is a higher low. And after this higher low, we had the last push to the upside, and this ending on a high that is lower than the previous high, so that's a lower high. The lower high is a swing point of a downtrend that is then followed with this aggressive downside movement which breaks below the previous low, turning it into a lower low. So initially the market was in an uptrend, but then the higher low is broken down into the first lower low we've had on this price action, especially with a candle closing below the last low. And this break is a trend change from an uptrend into a downtrend. On a downtrend, the market has swing points of a lower low that is then followed with a lower high, and that lower high translated into the price action is a pullback to the upside that can't break above the last high, but must end somewhere below the previous high. And the level it will usually end at is a supply or resistance taken from the previous swing high. That supply or resistance is the last upside candle before the price started to aggressively push down, which they would be around this level. And what we want from this supply is for this repeated lower high pattern that just started to basically keep holding this pattern at least one more time, because we can look for an opportunity to plan a sell setup down from the supply into a lower low, essentially expecting the price action to keep holding what it has done, which is to constantly break the previous lows into new lower low swing points. That sell setup can be planned from this time frame in the simplest way of doing it, but it might be a better idea to switch into a lower time frame the moment the price hits the high time frame supply, because this way we will see the same price and at the exact same moment, but in more detail since we see the price shared across multiple candles. For example, this is the 15 minutes time frame of the same level. With this approach, which I would call being a medium risk approach, we still analyze the price action that caused the supply to fill, and we see that from the lower levels it started having a bullish action, forming this uptrend pattern of higher highs with higher lows, which eventually it gets into hitting the high time frame supply. But if we look at the last movement, the price drops down and breaks below the last low. The last low was a higher low, and so if it breaks down, that means that this becomes a lower low. So if this price action was previously in an uptrend, since it had uptrend swing points, but now we got the very first sign of reversal, which was this break below the last low. This break is an internal market structure shift, or internal trend shift, from a low time frame uptrend into a low time frame downtrend. And on this approach, we can enter with a setup right after the trend shift. In this case, that would be a sell setup, with the stop loss above the high. Why above the high and not above the supply? Well, since the trend has shifted into a downtrend, we don't expect a higher high on a downtrend, so it's quite unlikely that we see the last high to break into a higher high. And if it actually does break above the high, then the uptrend is probably going to continue, and there's a good chance it continues even above the supply, and that would break the supply and of course lose any sell setup from this supply. And for the take profit, we still look to target one of the previous lows, since if the trend reversed into a downtrend, on downtrends the price will break past lows into lower lows. So right after it breaks into a lower low, which was the trend shift itself, right after that moment, the price begins to drop down quite aggressively. This bearish action keeps going and eventually it breaks below the other low, around the level where the take profit was placed, closing the setup. So if we come back into the higher time frame where we started the analysis, all we really did was notice that the trend has shifted into a downtrend, and we only planned a setup to trade with the trend. Down from the high time frame supply, we capitalized on this highly likely push to the downside that should be able to break the last swing low into a lower low. Now let's see on the next way, which is what I would call as being a lower risk approach. The first steps are exactly the same. We analyze the direction of the price action from a higher time frame. Here, for example, we have a lower high formation that is coupled with a lower low formation. So the market was following a downtrend at this exact moment. But after the last low, the price formed this upside impulse which creates a high that is higher than the previous one. So that's a higher high swing point. So the price basically broke above the last high for the first time on this price action. The first break above the high, which created the first higher high. That's a market structure shift or trend change from a downtrend, which was the previous trend, into a highly likely upcoming uptrend. We also see that the price is starting to pull back down. A pullback on an uptrend should not end below the last low, just like we previously had, having those lower low levels. But the pullback on an uptrend should end above the last high. That's because the uptrend has swing points of a higher high, which we already have right here, that should then be followed with a higher low. and that higher low is a downside pullback that ends above the last low. The level it usually will end is on a demand taken from the last low, so we need to identify that demand, which should be the last downside candle before the price started to push up, which is right there if we closely look at it. Now we just wait to see if the market pulls into that demand. However, it looks like it will since selling pressure is quite high. Now when it hits into the demand, we do the same thing as we did, and that's to switch into any lower time frame you'd like, as long as it's lower than the initial one. For example, we're now inside of the 5 minutes time frame of the same level, basically the exact moment the price has hit into the high time frame demand. And what we do inside of this lower time frame is that we analyze the internal price action, more specifically their swing points. Since we see that the trend that has led into the price hitting the high time frame demand, that trend was a downtrend of repeated lower highs with lower low swing points, but then we see that from the lowest level, the price started bouncing up, and this bounce breaks above the last high, creating the first higher high from this 5 minutes time frame. This break is what we now call as an internal market structure shift, or internal trend shift, from a downtrend into a possible upcoming uptrend on an uptrend. After a higher high, a low will be set, and that low should not end lower than the last one, but it needs to end higher. Basically, it needs to end as a higher low. The level it will usually end at is on a demand or support found from the previous low, and more specifically, a demand is the last downside candle before the market started going up, which would be around this candle. And this is what we call as an internal demand. It's internal because it's a low time frame demand that is inside of a high time frame demand. And this time, what we're doing is that we're trading the low time frame demand that's inside of the high time frame demand. So we're using the high time frame demand for the directional analysis and the low time frame demand for the execution of the setup. And that's a buy long position, with the stop loss below the low time frame demand and take profit above one of the previous highs. It can be the recent high that we have here, or for a better risk-reward ratio, we can target the higher ones as well. For example, above this one, and here we get a decently high ratio. This one from above, for example, it hits a 1-to-3 ratio, or the last from above, this targets almost a 1-to-4 ratio. That can be too much and too risky in most cases. I usually would not target for more than 1-to-3, even that it's more than enough. And if you're not confident, I would even go for 1-to-2, but try to avoid going for less than that. Price pulls back and hits into the low time frame demand. Buying pressure is increasing, driving the price up into what it looks to be an uptrending price action. This uptrending price action keeps going until it eventually closes the position on the take profit. Now, of course, each of these three ways have their advantages and disadvantages. On the high risk, you will find more setups but lower quality ones, meaning that you will have more positions but probably less winning ones. On the low risk, you will get less setups but higher quality ones, so less setups, but more of those should turn as winning ones. On the medium risk, it's kind of in the middle of the other two ways. Which one is the best or which one should you trade? I suggest you try all of them and see where you perform your best. Hope you found it helpful. Repeat the video to make sure you understand it well. And then we're also waiting for you in our program that you can find on the description of this video, where we don't only focus on winning, but more so on trading in a way to not lose your wins back.